In Omaha, 1946. A pinball machine rattles to life, brass buttons flashing like tiny stock tickers. A teenage boy empties the coin box, logs every quarter in a pocket notebook, and nudges the machine to a busier corner. He learns three things at once. Float, the cash you hold before you owe it. Roots, the power of placement. And the pleasure of money that works while you sleep. His name is Warren Buffett. 2 decades later, in a New England mill that smells of oil and lint, the lesson returns. The looms are dying. The balance sheet isn't. Berkshire Hathaway is cheap, stubbornly so. Buffett doesn't fall in love with fabric, he falls in love with cash that can be redeployed. He buys control, then bolts an insurance engine onto the chassis. With premiums today and claims tomorrow, float pools under the hood. Investable cash that, if underwritten conservatively, behaves like negative cost leverage. The snowball finds its hill, time. Compounding in Buffett's telling asks for 3 allies, a sound base, patient capital, and honest partners. The base became insurance, first National Indemnity, then Geico and reinsurance operations that could scale. Patient capital came from running Berkshire like a family, not a quarterly theater. No guidance, no Wall Street choreography, just letters explaining what happened and why. Honest partners arrived as a cast of operators who didn't need babysitting, furniture merchants who refused to be undersold, jewelers who measured success in trust, utility managers who prized reliability over applause. Decentralization wasn't a pose, it was a design. Headquarters would allocate capital and measure results. The people closest to the customer would run the business. But float without judgment is just a loan with a timer. The judgment came from a discipline honed early. Stay within a circle of competence, demand a margin of safety, treat Mr. Market as a moody neighbor whose prices are invitations, not commandments. Seize Candies was the first famous test. On paper, it looked pricey to a young bargain hunter. In reality, it was a cash fountain powered by brand loyalty and pricing power. A lesson crystallized. A wonderful business at a fair price beats a fair business at a wonderful price if you hold it long enough. American Express during scandal, the Washington Post when it was unloved, Coca-Cola when skepticism was cheap and sugar was out of favor. These weren't lottery tickets, they were toll booths. Pay once for quality, let time collect. Dividends piled up, share of mind deepened the moat. The portfolio became a garden that didn't shout, it compounded. Then came the operating crown jewels. A railroad, Burlington Northern Santa Fe, turned Berkshire from an investor in essential infrastructure into an owner. Rail cars pulling grain, coal, and containers didn't just throw off earnings. They stabilized the entire enterprise. Less drama, more durability. Utilities and energy, through what became Berkshire Hathaway Energy, added regulated, capital-intensive businesses that rewarded prudence and long horizons. Furniture and jewelry and paint and machine parts filled out the orchestra. The melody was steady cash, the rhythm, prudent reinvestment. None of this happened in a vacuum. At Buffett's side stood Charlie Munger, equal parts philosopher and prosecutor, who sharpened the shift from cigar butts with one last puff to great businesses that grow. Munger's latticework thinking kept the partnership curious and humble. He urged them to prefer a good business at a fair price over a poor one at a screaming bargain, to avoid envy and leverage, to invert problems until the trapdoors showed. If Buffett was the greatest buyer of time, Munger was Time's best editor. The machine proved its mettle in bad weather. In crises, when liquidity vanished, Berkshire arrived with cash and terms, preferred deals with fat coupons and equity kickers, lifelines to brand-name institutions that later read like case studies in asymmetric risk. The fortress balance sheet wasn't decoration, it was a spring. Patience in ordinary years created optionality in extraordinary ones. Evolution remained part of the blueprint. Technology, once outside the circle, moved inside when the economics were clear and the understanding earned. A fruit-branded company, quietly accumulated, grew into Berkshire's largest holding, a reminder that the philosophy wasn't anti-tech, it was anti-mystery. When comprehension arrived, capital followed. Even buybacks, long treated with caution, became a tool, used only when Berkshire itself offered the best prospective return for Berkshire's own dollars. Culture did the compounding you can't chart. A headquarters with fewer people than a mid-sized restaurant chain, annual letters that admitted mistakes in plain English, compensation that favored long-term behavior, a default to trust, hire well and get out of the way, tempered by a non-negotiable line on integrity. The rule book fit on an index card. Be honest, be rational, be kind. Lose any one of the three and the others won't save you. There were mistakes of commission and omission. An airline cycle misjudged, a shoe company that never earned its keep. Technology bets missed for years, then caught in one stride. The letters catalogued them without spin. The point wasn't perfection, it was process. Avoid what can kill you. Learn fast when it merely stings. What precisely is Berkshire? Not a conglomerate welded for fashion, and not a fund chasing every chart that twitches. It is a compounding chassis. Insurance float pooling at low cost. Wholly owned businesses sending cash upstairs. A balance sheet built to be brave when others are tired. A culture that attracts talent allergic to bureaucracy and in love with autonomy. The outputs are profits, yes, but more importantly, options. Options to buy when the crowd is forced to sell. Options to hold when fads demand motion. Options to be boring for years and brilliant in an afternoon. And what does it ask in return? Temperament. The willingness to look wrong in the short term to be right in the long term. The patience to let base hits turn into doubles without swinging for every fence. The humility to admit I don't know, and the courage to act decisively when you do. The discipline to keep cash when it's unfashionable and to deploy it when it's unpopular. Inevitably, every machine needs caretakers after its inventors. Berkshire planned for that quietly, the way it does most things. Responsibilities distributed, successors identified for operations and capital, investment managers trained by doing, not by slogans. The goal wasn't to embalm a personality, it was to encode a process, rationality, integrity, alignment. So the flywheel keeps turning no matter who oils the bearings. Return to that barbershop in Omaha. The pinball machine is still humming, the notebook's still open. The lesson hasn't aged. Cash arrives before obligations, roots matter, placement matters more, and the real trick is time. Now stand in a rail yard at dusk and hear the long horn roll across the prairie. Or watch a line worker in a hard hat tighten bolts on a transmission tower before winter comes. Or walk a candy plant where a brand scent is a moat. Berkshire isn't magic, it is plumbing, built carefully, maintained obsessively, so that compounding has an unclogged path. In a world that worships speed, Berkshire chose endurance. In a market that rewards noise, it chose signal. In an industry that sells certainty, it sold honesty. We will be wrong sometimes, we will be quiet most times, and we will be ready when it counts. That, in the end, is how Warren Buffett built the ultimate compounding machine. A company that made time its senior partner, turned patience into power, and let simple ideas, well understood and faithfully applied, do what fireworks never can.